Hello everyone, welcome to my channel. Today I'm going to talk about tax rules for home flippers. Before I get into the video, be sure to subscribe and leave a comment below saying I subscribe. I will try to personally reply to your comments. With mortgage interest rates low, flipping real estate appears to be on the rise. This activity is even the theme of several popular reality TV shows. House flipping is essentially purchasing a house or property, improving it, and then selling it, presumably for a profit, in a short period of time. The key is to find a suitable fixer-upper that is priced on the market for its location. Fix it up and resell it for more than it costs to buy. Hold, fixed up, and resell. Are you contemplating trying your hand at flipping? If so, keep in mind that you will have a silent partner, Uncle Sam, who will be waiting to take his share of any profits in taxes, and most likely Sam's cousin in your state capital will expect a share too. Taxes play a significant role in the overall transaction, and tax treatment can be quite different depending upon whether you are a dealer, an investor, or a homeowner. The following is the current tax treatment for each. Dealer in real estate: gains received by a non-corporate taxpayer from business operations as a real estate dealer are taxed as ordinary income, which is 10% to 37%. And in addition, individual sole proprietors are subject to the self-employment tax at 15.3% of their net profit, the equivalent of the FICA taxes for a self-employed person. Higher income sole proprietors are also subject to an additional 0.9% Medicare surtax on their earning. First, a dealer will generally pay significantly more tax on the profit than an investor. On the other hand, if the flip results in a loss, the dealer won't be able to deduct the entire loss in the year of sale, which would generally reduce his or her tax at the same rates. Investors' gains as an investor are subject to capital gains rates, maximum of 20% if the property is held for more than a year, long term. If held short term, less than a year, as will likely be the case for most flippers, ordinary income rates 10 to 37% will apply. An investor is not subject to the self-employment tax but could be subject to the 3.8% surtax on net investment income for higher income taxpayers. A downside for the investor who has a loss from the transaction is that after combining all long and short-term capital gains and losses for the year, his or her deductible loss is limited to $3,000, with any excess capital loss being carried over to the next year. The rules get a bit more complicated if the investor rents out the property while trying to sell it, but such rules are beyond the scope of this video. Homeowner: if the individual occupies the property as the primary resident while it is being fixed up, he or she would be treated as an investor, with three major differences. 1. If the individual has owned and occupied the property for 2 years and has not used a homeowner gain exclusion in the 2 years prior to closing the sale, he or she can exclude gain of up to $250,000, $500,000 for married couple. Secondly, if the transaction results in a loss, the homeowner will not be able to deduct the loss or even use it to offset gains from the other sales. And thirdly, some fixed-up costs may be deemed to be repairs rather than improvements, and repairs on one primary residence are neither deductible nor includable as part of the cost basis of the home. Being a homeowner is easily identifiable, but the distinction between a dealer and an investor is not clearly defined in the tax code. A real estate dealer is a person who buys and sells real estate property with a view to do trading profits to be derived and whose operations are so extensive as to constitute a separate business. A person acquiring property strictly for investment, though disposing of investment assets at intermittent intervals, generally does not deal in real estate on a regular basis. This issue has been debated in the tax courts frequently, and both the IRS and the courts have taken the following into consideration: whether the individual is already a dealer in real estate, such as a real estate salesperson or broker, the number and frequency of sales flips, whether the individual is more committed to another profession as opposed to fixing up and selling real estate, and how much personal time is spent making improvements to the flipped as opposed to another profession or employment. The distinction between a dealer and investor is truly based on the facts and circumstances of each case. Clearly, an individual who is not already in the real estate profession and flips one house is not a dealer. But one who flips 5 or more houses and or properties and has substantial profits would probably be considered a dealer. Everything in between becomes various shades of gray, and the facts and circumstances of each case must be considered. Thanks for watching this video, and do not forget to subscribe to my channel.